Good afternoon. Can you all hear me?
Yes, sir.
Okay. Have you received this handout which I have shared? Financial Markets Products Part 2.
Yes, sir.
Okay, you have it, right? Now we are moving to Part 2 of our discussion on financial markets and products. Now, before that, I think last week the central bank has announced its monetary policy press release, and I have already always mentioned to you that you have to look at the central bank press release when it is published, because some important information is contained in this press release. For example, the level of interest rates, the policy rates, whether there is a change, what is the current monetary policy. Likewise, I think, and I really advise you basically look at this monetary policy press release. It's already announced on Thursday, so please take a look on that. Given the interest of time, I'm not going to discuss that in detail, but I really recommend you look at it. Now today we will be looking at financial products or securities which are traded in the financial market. Now last week we had a comprehensive discussion on the markets, what type of markets that we can observe in the financial markets, and they are functioning, we have adequately covered. Now today we are looking at the instruments that are used in these markets, because markets may not be functioning without instruments. So if the market is the platform to do the transactions, you have to have financial securities or products. Now, how do you determine or define these financial instruments? You can call it instruments, products, or securities. So, whatever the term we use, it's a contract between the two parties. What are these two parties? It could be a lender or a borrower, it could be an investor or investee, it could be simply person who's offering a financial product and who's accepting a financial product. So basically there are two parties, so it's a contract between the two parties that would be creating an asset for one party and a liability to the other party. For example, if it is a deposit, let's say it's a deposit instrument, a financial instrument is the deposit. So if a particular person is coming to a bank and starts a deposits, that means that deposit is an asset of the depositor. On the other hand, when he deposits that money in a bank, the bank or the banker is having a liability to pay. Take another example, a stock. So if there is a stock instrument, let's say equity, person who's issuing equity is having a liability to pay. Why? When he issues that equity people would buy. So you have to pay those buyers later on for those funds. Person who's buying an equity or a stock, he is having an asset. So likewise, if it is a financial contract or an instrument, there are two parties. One is having an asset, one is having a liability. So this instrument is a tradable asset. You can trade it. What are these tradable assets? It could be cash, it could be an evidence of an ownership, etc. etc. So the financial instruments are traded in financial markets. It could be either in direct finance or it could be in indirect finance. If it is indirect finance, basically deposits and loans where you have an intermediary in place. If it is direct finance, basically maybe bonds, maybe equity. Those are traded directly in those markets. So whatever the market type, this creates a kind of a tradable asset for market players to exchange their financial flows. So what are the key types of financial instruments? You can list out a number of instruments. I think in this picture I have covered as many as instruments. What we have: deposits, loans, treasury bill bonds, commercial papers, debentures, corporate bonds, asset-backed securities, leases and hire purchase, shares, derivatives, etc. There are a number of instruments that you can find or observe in the financial market. Some of these instruments are very traditional, some of are very new instruments. In some countries, some of the instruments are traded heavily. In some countries, some of the instruments are not traded heavily. Now, for example, in our country, these bonds are, it's a main instrument in our market. But derivatives, it's not a main instrument in our market. So depending on the market type, the level of development, these financial instruments would be used depending on their popularity. Now let's look at these instruments one by one, and I will be basically giving an overview of each and every instrument in this part. But it will be a little fast because I plan to cover this session today. What are deposits? I think that is the most common and very familiar instrument for us. So it is sum of money placed with a financial instrument for the credit of customer's account. If you are the customer, if you go and place money with a financial institution, could be a bank as a deposit, that would create a credit entry in your customer account. So let's say you deposit 1,000 rupees, that 1,000 rupee becomes a credit entry in your passbook or whatever, and that is reflecting your assets. And there are three major types of deposits: demand deposits, savings deposits, fixed or time deposits. And another form you can add it there, call deposits. So these are the types of deposits that you can observe, maybe not only among banks but also among other non-bank institutions. They are also offering deposits. So let's look at these deposits, different types of deposits. I'm discussing these different types of deposits or whatever the instruments because in your exam you are required to give some definitions, some comparisons, etc., etc. So for that matter, you have to have some idea about these different instruments. First, demand deposits. They are mainly used for transaction purposes. Sometimes these demand deposits, you call them as current accounts. Probably you may have heard the term current accounts. In commercial banks, you have these accounts. Why you call it demand deposit or a current account? You can withdraw money at any time on demand. So in these accounts, the money is considered as very liquid, very highly liquid. You can withdraw at any point. No need of having prior advance. So as a result, this money in these accounts are kept by commercial banks in short-term form, which means they are not investing such money in long-term instruments because you have to have money when people demand. So that's why you call it demand deposit or a current account. These accounts, they do not earn any interest. As you know, current accounts do not have any interest, but they have some facilities attached to the account. What are these facilities? You can have check facilities, you can have standing orders. Standing order means you give some prior advance notice to pay someone at a particular point in day, particular amount. Those you call as standing orders. ATM cards, debit cards, all these are facilities attached to this current account. And one of the important facilities attached to current account is, which I have not mentioned here, OD facilities, overdraft facilities. Customers can withdraw or ask for more money than the balances in their accounts. So it's a kind of a temporary loan. You call it temporary overdraft, TOD. So people use these TODs as a facility of these demand deposits. Savings deposits, I think most of you are aware, they are the deposits people make to earn some interest. So this interest can be daily, weekly, monthly, or yearly. Likewise, depending on the product that you have, you might have different interest components. So in these accounts, you can withdraw money at any time. Like a current account, you can withdraw money in your savings account. And to do that, in modern days, you know, you have some additional facilities provided by the banks. You have an ATM card, or debit card, or any other type of card to facilitate this. Banks are issuing passbooks or statements for these accounts. Nowadays, they are offering e-accounts, which means you don't have any physical passbook. Instead, you have e-passbook. And also you have online banking facilities for these savings deposits. Right? Then we have fixed deposits. In a fixed deposit, funds are placed for a specified period. Could be 1 month. I think the lowest FD period is 1 month. You are placing that money for 1 month. You don't withdraw before 1 month. If you place it for 5 years, you don't withdraw before 5 years unless you have a real need. So funds are placed for a fixed period, specified period. Could be 1 month or 5 years, doesn't matter. But during that period, funds are fixed or placed on a fixed manner. So as a result, banks are able to, or financial institutions are able to use this money for long-term purposes. Because it is for a specified period, so they can use it for a specified longer period, and as a result they are able to earn more on the money raised through these fixed deposits or time deposits. And as a result, they pay higher rate of interest than the savings accounts. So as I mentioned, money could be short term, medium term, or long term. As I said, it could be even 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year. Likewise, can be different periods that money are kept in the accounts as FDs. You can withdraw money before maturity, but you have to give some prior notice to the bank. And also you will be charged some additional rate, which you may call it as a penal rate, because when you liquidate the long-term investment, long-term deposit, the banks might be also facing some issue. To compensate that, they charge a penalty, and also that discourages people withdrawing FDs. And one of the important feature of FDs in modern days, you can use it as a collateral. Collateral means you can keep that FD value as a security to borrow. So a lot of people who have FDs with banks, using that bank deposit, against that deposit people borrow. Let's say you have 100,000 FD, you can ask the bank to give 100,000 loan against that, because that is the security. Normally banks do not give 100%, they will keep a kind of a share, you call it a haircut. So other than that haircut, the bank would give them a loan. So what is the security? That is the FD. Okay. Then we have, those are the three main: demand deposits, savings deposits, and time deposits. Then we have call deposits. Call deposits is a kind of a hybrid instrument. Hybrid in the sense it has feature of savings and checking account. Why do you call it savings or checking account? Both features. As a check-in account, check-in means demand deposit, you can withdraw money at any point. And no fixed period for the deposit. Why do you call it a savings account, a type of savings account? Because it offers some interest for you. So it's a kind of a mix features you have in a call deposit. So like a mixture of savings and a current account. Loans. I hope you are listening to me. Are you there? Because I can't see you. I hope I'm okay. Because I'm checking time to time. Probably sometimes our technology may have some disruptions, and even I don't know, even you don't know, probably. So there could be some disruptions. That's why I'm checking time to time. Then we have loans. As I said, deposits are very common as a financial instrument. Loans are also very common as a financial instrument. How do you define a loan? Sometimes you should know how to define, because maybe you need to give such explanations or definitions. So loan is a specified sum of money provided by a lender. So that lender generally could be a financial institution to a borrower on such conditions. What are the conditions? You have to repay either in installments or at once, at agreed dates, and at agreed rate of interest. So you can say a loan is a contract between a lender and a borrower to borrow a specified sum of money with the condition to repay it during agreed time with an agreed interest rate. So generally, when now loans are provided by banks, non-banks, even individuals, anyone can provide a loan. So these loans, when people provide a loan, even a kind of a, let's say, informal lender like a Polimudalali, when he lends money, they basically require some form of security. Most of the loans, they need a security. There are some loans without security, I'll come back to that. But in general, more than a greater percentage, you need a security, right? Security means kind of a collateral. Collateral. Collateral means security. In Sinhala, you call it apasurakumpa or apayak. So this is neat. So financial institutions provide these loans at a cost. So they charge that cost. So when financial institutions give a loan to a borrower, they incur a certain cost. You call it an opportunity cost. Why? Without giving a loan to that borrower, the bank could have used that money in something else. So you call it an opportunity cost. Considering that opportunity cost, the cost of money, the bank or the financial institution would determine a rate of interest. So loans, always you have to pay an interest as the compensation for the usage of money. So what are the types of loans we have? As I already mentioned, most of the loans are secured, which means the borrower is pledging some asset. The best example for a secured loan, when you take a housing loan, you have to keep or pledge that house or a land as the security. If you take a vehicle loan, you have to pledge the vehicle as a security. If you take a kind of another loan using your FD, you have to pledge your FD as a security. So if a borrower has pledged some asset against the value of a loan, that you can call as secured loan. Unsecured loans, the second one. So unlike secured loans are loans, monetary loans that are not secured by any asset. So in this case, there is no security involved. The loan is given purely based on documents. For example, if you take a personal loan, in a personal loan, you don't have to have any asset to be pledged. Only thing, you need some guarantors, so some kind of assurance from someone that you will pay. Other than that, you don't keep any security with them. You don't pledge any security with them. So what are the examples for such loans? Credit card loans. So when you use a credit card, you don't have any security attached to it. Now these days, New Year days, you must be using your credit card for New Year purchases. When you use a credit card, you buy something, you own let's say a good or a service using the credit card. For that matter, the bank is giving you a loan and you don't pay any or keep any security for that matter. You pay an interest, but no security is pledged. Only to have a credit card, you have to have some guarantors. That's it. Personal loans. When you take a personal loan from a bank, no security is given. You only kind of a recommendation or some guarantee from some other party. Bank overdrafts, as I said, using a current account, someone can ask money more than the balance. You call it a overdraft. So such overdrafts, you don't need any security. So unsecured loans mainly offered by commercial banks without any security. In the markets also, in broad markets, you can observe these secured and unsecured loans, which means in money market, if you take a repo market, it's a secured market. So in the repo market, what you are doing is basically you are giving securities and getting money. Or you are giving money, getting securities. Some form of security is there in a repo market. So in broad markets also these are happening, not only with individual investors or lenders or borrowers. In the broad financial markets also you can observe it. Can somebody give me an example for unsecured loans in markets? So money in the repo market, you call it a money market. You have this in money. Can somebody tell me an example of money market where you have unsecured loans between the market players? Any response? Any response? I would like to hear from you, please. Example for unsecured market where you borrow or lend money without any security for your counterparties, let's say for a bank. Any idea? Someone is responding in the chat. A promissory note. No. Any other answer? Promissory note. I think your answer can be accepted. In a promissory note, yes, you give some kind of a promise to pay, and you might take a kind of a facility. But that promissory note itself is a kind of a security, isn't it? In the case of a failure, that promissory note is having a kind of a guarantee. So you may call it broadly as unsecured, that's correct, but it has some form of guarantee to pay. But your answer is okay. Yes, I see some examples here, answers here. Interbank cold money market, Diluka, Diluka, I'm not so sure. That answer is right. Interbank cold money market. In the interbank call money market, there is no securities involved. You don't have any security involved. What you basically have is a money flow only. You give a loan to another bank, that is interbank, then that bank is repaying you on the following day without any security. You don't have any security. Bank A is borrowing from bank B, no security. It's completely based on the trust, completely based on the confidence on other market players. So I'm having some questions here also. I'll come back to that with our discussion, right? Then we have another type of loan, subsidized loans. A subsidized loan means there you have interest rate is reduced by an explicit or hidden subsidy. Now, if you are a customer, if you are taking a loan, you are getting the loan at a reduced interest. That is what meant by subsidy. But the point of subsidy is borne by someone else. Now let's say I'll give you a basic example. Now during the COVID period, the central bank provided a loan of 1%. Sorry. Let me check whether we can take that example. No. We'll take another example. Let's say the central bank, the customers is getting a loan at 4%, for example. Okay. Now, actual cost of this loan is actually 8%. So, commercial banks cost is LCB, cost is 8%. So, their cost of money is 8%. They have to have 8% in order to them to be profitable. But as customers, you are getting the loan at 4%. So this 4% is subsidized rate or reduced interest rate. Now, if you look at, there is a gap of 4%. The bank should have 8%, but it's only receiving from the customers 4%. So this balance 4% either borne by the government or central bank or whoever, right? Someone is bearing that cost. That is the problem of a subsidized loan. Someone is bearing the cost of the subsidy. For example, agriculture loan, if farmers are getting agriculture loan at 4%, the cost is 8%, the balance 4% is borne by the government. If students are getting a loan at 3%, the banks are not in a position to give at 3%. Their rate is 60%. So the balance 3% is borne by someone else, maybe by the government. Okay. So these loans are called as subsidized. Then we have concessional loans. Concessional loan means the lender actually giving a lower rate or some concession. Now, for example, international institutions are giving loans to governments. ADB, IFC, IMF, World Bank, likewise. They are giving loans to the government. So these loans are generally provided at low interest rates, maybe 1%, 2%, 3%, for example, low interest rates. And also with some other concessions. What are the concessions? You can repay the loan during a long period of time. You can pay for 30 years. And out of the 30 years, first 2 years are waived off. You don't need to pay. Likewise, there are a lot of concessions are attached to a concessional loan. So normally it happens between governments and uh, institutions. Even private company can have a concessional loan. For example, for their employees, the company is having a loan facility. Normally, those loan rates are low. In many institutions, if they are providing a loan by the institution to their employees, it's a low interest rate, and that is for a longer period. So all these suggest loan is at a concession. Then another type we recently hear very common, syndicated loans. Syndication means collection. The meaning of syndication is collection. So here what happens, a group of lenders are forming a kind of a fund together, or they are getting together and collecting money, large amount of money, to finance a single borrower. For example, the Sri Lankan government needs $1 billion. Let's say foreign currency, money, loan of $1 billion. And generally, private investors, they do not have that amount of money to give a loan to $1 billion to Sri Lanka. What they will do? They will collect few lenders. So let's say they form a group of 5 people. Each group person provides 200 million, 200 million, 200 million likewise. Then you form 1 billion. So syndicated means financing offered by a group of lenders for a single borrower. As I said, countries can borrow that way large amounts. And this facility is arranged by some facilitating banks. Let's say to have 1 billion to the government, there is a syndication loan, syndicated loan, and that syndication is arranged by some few banks. You call them as lead managers. Lead managers. So these are different types of loans that we observe. So we have some idea about deposits and loans. Then let's look at debt and equity. Debt instruments are there, equity instruments are there. So first let's look at debt instruments. Debt means simply the meaning of debt is loan. Now in the earlier slide, what we talk of as loans as, the bank loans, financial institutions loans. But that is also part of the broad concept of debt. So in financial system, other than these bank deposits, bank loans, there is a broader category called debt. Bonds are coming under this debt. Bank loans are coming under this broad concept of debt. So what are the features of debt? Debt instruments do not have any ownership interest. If you are having a debt instrument, there's no ownership is attached to that debt instrument. For example, let's say you have a government debt instrument. What does that mean? You don't have any ownership of the government. It's only an instrument certifying that you are owing some amount of money. So in debt instruments, creditors, which means the people who have raised, from whom you have raised money, the lenders actually, they do not have any voting rights when it comes to company matters. as I said, if you have number of debt holders in your company, those debt holders do not have any role to play as voters in the AGMs or whatever. So no ownership interest is there. So as a result, no voting is there. In debt, you basically charge interest or interest rate. So that interest is the cost of doing business. What you get as the interest is a compensation of your funds, right? Then if you are a creditor means lender, you have a right to go for legal recourse if your payment is missed. If your money is not paid, you can have a legal action against the company. And then another feature is basically, I already mentioned this interest rate. When you have interest cost, that is tax deductible. When you calculate in income taxes, that interest cost can be adjusted because it's an expenditure. Debt is good in the market. You can raise money from others by issuing debt instruments. But the problem is too much debt is bad. So excess debt would create financial distress, even bankruptcy. So you have some tolerable level of debt, not too much. Even for a country, we say the debt level should be tolerable, should be manageable, right? So you have to have sufficient levels of debt, not too much debt. Then let's look at equity. Equity means actually stocks, right? Or sometimes you call it shares. Same thing. So what are the features of equity? When you have equity, a share, you have the ownership. If you have 100 shares of particular company, you have the ownership of that company, limited to that amount of shares that you have. When you have shares, you can vote in the elections of these companies. Elections means annual general meetings. To elect board of members, board of directors, other issues, all these matters you can have vote. Now, for debt, you pay interest. For equity, you pay dividends. Dividends means cash income. Now, when you pay cash income, it is not considered as cost of business. I already mentioned if interest is charged, that interest is cost of doing business. And that can be adjusted from the taxes. But dividends are not considered like that. They are not cost of doing business. Therefore, they are not exempted from taxes. So dividends are tax deductible. But the firm does not have any obligation to declare dividends. There could be some dividend years the company does not pay dividends. So dividends are not a liability of the firm until it is declared. And then if dividends are not paid, you cannot have any legal action against the company. You expect dividends, or you can talk in the annual general meetings and all that, but you cannot claim I have a right to say that I have a right to have dividends. So dividends are paid by considering company's financial position. If a particular company is having a good financial condition, then dividends would be paid. Okay. Now this debt and equity. So last one, all equity firm cannot be go bankrupt, which means if a particular firm is having 100% shares, there is no debt, so that firm cannot bankrupt. That is the idea. Now in a company, if you look at their balance sheet, you might observe they are having both financial instruments, debt and equity. From this slide, we know if they have 100% debt, that is very risky. If we have some debt and some equity, that is acceptable. So when a firm is having, let's say, in their total capital, if you look at their capital component, if they have this much of equity and this much of debt, based on that, you can have some idea about the percentage of debt that they have. Percentage of, you call it leverage. Leverage. Leverage means percentage of debt. How do you calculate this leverage ratio? Leverage ratio is defined as D divided by S. D means debt, S means stocks. So compared to stocks, if you have less amount of debt, then that company can be considered as a kind of a healthy company because you have less debt. Compared to equity, if you have more debt, let's say you have 100% debt, 110, 15% debt, then that indicates that company is very risky. Any questions up to this point? Any questions? Is anyone having any questions? Any discussion point? Let me check. I can hear some messages are popping up. No questions, but I think some answers are there. Does someone want to raise a question? I can hear some voice. Right. If not, let's move. So can you explain equity again? Yes. Equity means shares. The company can issue shares to raise money. Okay. For example, let's say a particular company wants to expand their operation. They need money. What are the options to have money? Either you can get from a bank a loan, or you can issue equity shares to have a expansion, to have money. So without going to a bank, you go to a bank, then that is debt. You take a loan means debt. Without going to a bank, company can go to a market and issue shares. So when they issue shares, you call them as equity or stocks. And it has certain features. Those are the features that I have discussed in this slide. So what I have mentioned, when you have equity, to the extent that amount, you have some ownership of that company. And you can be a voting person when you when it becomes company matters. Elections, appointing board of members. Likewise, at the AGM annual general meeting, you can vote. For equities, you mainly get dividends. In loans, you pay interest, but for equities, you don't have interest. You have dividends. The dividends have to be declared by the company. Dividend means simply the net income. Now, net income is the profit. Profit can be shared equally among the shareholders. So you call it a dividend. I hope that is clear. And someone asks, what is leverage? Leverage means, as I said, you can, in this, let's say in a company, you have both debt and equity. So this is the total financing mix. Leverage means how much debt you have compared to equity. That is the idea of leverage. So if this leverage is high, which means you have more debt compared to equity, that indicates some risk. Remember, I mentioned here, having excess debt is a problem. If this ratio is low, then such company is having some good financial position because they are not exposed to too much risk. So comparing the level of debt against the level of equity is the leverage that you call as leverage ratio. Okay, clear? Isuri, is it clear now? Leverage? Amanza, is it clear about it?
Okay, sir.
Okay, right. Let's move on. Now let's move to debt instruments. Now I told you, now here we talk about this debt. I mentioned to you, debt means you are taking a loan. So loans can be taken in many forms. One is bank loan, right? Other type is through bonds. I think bank loan clear. No? We already covered bank loan. In the previous slide, we discussed bank loans in detail. So that part is done. Then the other part is bonds used to raise debt. So in the next slide, we are talking about bonds. A bond is a debt instrument. We already know now that. So what is this debt instrument? It's a kind of a certificate showing that the borrower owes to pay a specified sum to the lender. A bond is a debt instrument, which means it's a kind of a certificate showing that the borrower means who's taking money for their needs, he owes specified sum. Owe means he has to pay, he is liable. Usually we call them as fixed income securities because a fixed income is attached to that. You will see that in a minute. A bond is having a fixed income. It does not change quarter or monthly. Normally, governments as well as the private sector can issue these bonds for their funding needs. So governments can issue bonds, corporates can issue bonds. Government means, I think it's clear. Corporates means the private sector. So you can have both private bonds and government bonds. What happens there? You raise money from the investors with the promise that you pay in the future. I already mentioned to you, a bond is a kind of a certificate, right? Likewise. So in this certificate, what you have is such and such date you will pay. So it's a kind of a promissory note, a kind of, you promise to pay. Now in modern days, these physical certificates you don't have, paper you don't have. In modern days, bonds are issued basically in electronic form. Still, what you have is basically a kind of a promise by the government or the corporate that they will pay back. So what are the features of a bond? In a bond, you have a cash income. That cash income is actually the coupon payment. If you say there is a 1,000 value bond, so if this bond is paying you 10%, that 10% means coupon interest rate. By holding that bond, you get this much of cash. That is the idea. Not every day, every 3 months, for example, or every 6 months, depending on the type of the bond. So this cash income is basically captured by the coupon payments. Then the coupon rate is at which rate you pay cash. Now let's say you have a 100,000 value bond, you get 100 rupees as your cash income. So that cash income 100 means your coupon rate is 10%. So coupon rate is the rate of cash income. Face value means what is the value of the issued bond. By looking at the bond, what would be the value? Usually face value is given by 100 or 1000. In most cases, it is given as 1000. That is the benchmark face value, right? Time to maturity, which means how long it will take to mature the bond. Some bonds are issued, let's say 5 years, which means time to maturity is 5 years. Let's say after 2 years, what happens to that bond? So then you call it a 3-year maturity bond because the remaining period is 3 years. So that's why you call it time to maturity. How long will it take to mature? Required rate of return, sometimes you call it yield to maturity, which means by holding this bond, how much you earn in total. It's not the interest rate, right? Interest rate we already covered under coupon rate. It's actually what you actually earn out of this bond. Call it required rate of return or yield to maturity. Bonds are generally tradable. I told you when you trade, you can exchange in the market. So depending on your need, you can time to time exchange, which means it is tradable. Now, with regard to bonds, we need to understand some of the important features. I mentioned to you, bond has different features. Now, if you take a bond, if you take this example, you have a 1,000 rupee bond means this is face value, right? That pays 6% interest, which means coupon rate. For 5 years means your maturity is 5 years. Right? And you will collect interest payment 60 means this is coupon in cash. So most of the features I mentioned here are basically identified here. So based on this bond, you can observe if the bond is paying you 6% coupon rate, and if you hold it for 5 years, you can basically generate 2 types of cash flows out of this bond, or 2 types of money that you make out of this bond. So what are the 2 types of bond, the benefits you make, money you make? First one is interest. Second one is capital gain. Now interest you can identify from these numbers. What is your face value? 1,000. That is your bonds face value. You have information given. Every year you get 6% as your coupon rate. So 1,000 into 6%, this is here calculated, which means 60 rupees in the first year. Second year, 6% into your face value, another 60. Third year, same. Likewise, the entire amount during this 5-year period is equal to 300 plus 300 is your total income out of this coupon payments. If you take that total, you can call it total coupon payments. It's 300. At the end of the period, period number 5, the total principal and the interest now equals to 1300. Why? Because you bought it 1000. Sorry, bought at 1000. Now it has become 1300 with the coupon payments as well. So that is based on this interest. Second, I mentioned to you, capital gains could also be there. Now in this part, you talk about capital gain. But you say you could also decide to sell that bond to someone at 1100. Now what happens? You have a difference between the buying price and selling price right now. What was your buying price? It's given by the face value. It's 1000. So you already bought this at 1000, but what is your selling value now? Current value 1100, which means there is a 100 rupee difference that you call as the capital gain. You call it as a capital gain, right? So for a bond, you have both. You have the capital gain, you have the coupon payment, no interest component. The total return is coming from both capital gain plus as well as interest. Okay. Now, if you are studying financial instruments, you have to understand this very well. The capital gain and the interest of a bond. The other thing we want to understand with regard to bonds is the total return out of this bond. Now, based on this previous slide, we can identify the total return of the bond. The total return of the bond, you call it as the holding period return. So holding period return means if you keep this bond there for entire 5 years, for example, what would be your total income? Now from this previous slide, we have seen your total income is coming from capital part, capital gain part, as well as interest part if you keep it for 5 years. As a result, the holding period return has two components: capital appreciation, cash income. So this formula, simple formula, is giving you some idea. Holding period return, HPR means holding period return. RT is total return, same thing. Either you call it HPR or RT, same thing. This is how we calculate the holding period return. PT minus 1, which means PT means current price of time T. PT minus 1 means previous price, what you have already purchased, that is the price. Plus CFT means cash flows, divided by PT minus 1. So if you look at this example, you will see this part of the equation is capital appreciation. What is the difference between the current price and the previous price? That is capital change or capital appreciation, capital gain, whatever. Then you have cash flows, which means coupons. So in 5 years time, you had 5 coupons. Total in the previous example, 300 rupees as the coupon. That entire amount you call it as cash income as a percentage or divided by previous price. Now, based on this formula, can you calculate the holding period return for the information in the previous slide? So in this slide, you are given, maybe I'll remove these doodling, then you will understand. It will be clear. So based on the information in this slide, where you have information on a particular bond, can you calculate HPR, holding period return? Now this is very important when you are working in working conditions. You have to have these things in your mind. You have to do calculations and compare, give a best solution advice to your boss. So you should know these things. Can someone tell me the holding period return in this case after calculating it? How do you calculate? How do you define it? The difference between the current price and the previous price, T minus 1 plus cash flows, total cash flows divided by the previous price. And if you look at this, same thing. Can someone calculate and let me know? Would you like to take a try? Is someone trying? Let me check your answers. So how do you calculate? I'm not so sure the number. How did you do? You take the difference between the current price and the previous price, which means current price means what? 1100 minus 1000. That is the previous price. So this part is the capital appreciation. Plus you have coupons. How much? 60 into 5 coupons is 300 divided by previous price, which means 1000. So how much you get it if you solve this? The difference is 100 plus 300, altogether 400 divided by 1000, which means 0.4. Someone has written as 0.4. So I think you have some decent idea about this, how to calculate the holding period return. Now in the exam, we haven't come across this calculation, holding period return. But there are some related questions. So you should know how to do it. And as I said, maybe in your working environment, you would need this. Next point related to bonds, there is a relationship between bond prices, interest rates, and coupons. So the very important relationship between the bond price and the interest rate is the negative relationship that we observe. Between the bond price and the interest, there is a negative relationship. So on this axis, in this chart, we have bond price. In this axis, we have interest rate. Sometimes you call it yield to maturity. You already mentioned. So price and interest has a negative relationship. Now, somebody might ask, why is that? The reason is coming from the bond valuation formula, which I'm not going to cover. I'm not going to discuss. So if you plug numbers into that formula, you will see there is a negative relationship is derived. You will see when the interest rates are going up, the prices are coming down, right? So this negative relationship is very important in the context of bonds. Why? It determines whether a particular bond investment is profitable or not. Here I have given you a summary. When interest rates fall, the price of a bond will rise. When interest rates rise, the price of a bond will decline. Why it is important? Now let's say you bought a bond here at 4%. Right? So your bond interest is 4%. At that time, to buy that bond, you pay 1,300 here. So this is your investment. To have this 4% bond, you have paid 13,300 money. So 1,300 money. Now you hold it. Let's say you hold it for a few years, and later on you will see interest rates in the economy gone up to 10%. So interest rates have increased. So at that 10% interest, what is the bond value? It's only 900. So bond value has come down by around 400. So this is a loss. So that's why investors are worried about interest rate then when they invest in bonds. So when bond interests are changing, the value of the bond is changing, and as a result, there could be profits or losses for the investor. So the most profitable way would be to earn the appropriate way to earn profits through bond investments means you buy at a particular interest rate, and in the future, if interest rates go further, then people make money. Nowadays, in the economy, I think we can observe this. Now, these days, interest rates are low, which means their bond price is high. They may have purchased bonds at high interest rates, so which means at lower price. Now, if you sell those bonds, they can earn a profit. Okay? That is one thing, the relationship between bond price and the interest. How the coupon is related? There is a relationship between the coupon and interest rate. Okay? If the coupon interest and the yield to maturity, which means interest rate, is equal, you call it a par bond. You have to know this terminology. Bond at a par. At that price, at that level, bond price is 1000, should be 1000, equal to face value. So bond issued at the face value. I told you no 1000, no 100 or whatever. So that 1000 means face value. If the bond is at a par, it should be equal to the bond price. That's one condition, one situation. There could be situation the coupon is above the interest rate. Then such bonds are called as premium bonds. So in a premium bond, their bond price is greater than the face value. We know face value is 1000, bond price could be 1100. So it's above the face value. So these bonds are called as premium. Why it is a premium? Because you are getting high price than what you have paid. Your coupon is higher than the market interest means you are earning more. So such bonds are premiums. The meaning of premium means that's good, right? So such bonds are considered as profitable or premium bonds. Then the other condition is coupon rate is lower than the interest rate. There could be situations what you earn out of the bond as coupons are lower than the market interest rates. Then you may call that bond is selling at a discount. So at that price, your bond price is not lower and not higher. Now it is lower than the face value. For example, your face value is 1000, your bond price is 900. So there you have a gap between the face value and the bond price. So out of this discussion, you only need to keep in mind two things. First thing, there is a negative relationship between bond price and the bond interest. When bond interest goes up, bond prices would fall. When bond interest are, I'll repeat it again, there is a negative relationship between bond price and interest rate. When interest rates are rising, bond prices fall. When interest rates are reducing, bond prices would increase. So depending on the interest rate, you earn a profit or a loss out of a bond. That's the first thing I mentioned. Second thing I mentioned, there is a relationship between the bond price, interest rate, and the coupon. So if the coupon and the market interest rate are equal, you call it a par bond. Bond is trading at a par. If coupon is greater than the interest rate, you call it a premium bond. If coupon rate is lower than the market interest rate, you call it a discount bond. People would like to buy discount bonds because its price is less than face value. So if it is less than face value, people would like to buy it because people would expect in the future the prices would go up. So investors sometimes they prefer discount bonds because there is a possibility that prices go up and they can earn money out of that. Any questions, please? Let's move on. Now, what I have mentioned so far, broadly, what is bond? What is a bond, right? And then we looked at the features of that bond and how the bond values are changing because of the interest rate changes that we have covered. Now let's look at the types of bonds. There are different types of bonds. Broadly, we can divide these types into government bonds, private bonds. Now, government bonds are basically the treasury bills and bonds. When we say government bonds, we basically refer to treasury bills and bonds, and there are some international bonds as well. I'll come to that point in a while. So, domestically or in the local economy, governments are raising money by issuing government bonds, treasury bills and bonds. Government bonds or treasury bills and bonds are guaranteed by the government, and they are considered as safest of all investments. Out of the investable securities, government instruments are the less riskiest instruments. Sometimes you call them as default risk-free or gilt-edged securities because government doesn't default. Governments never default. It's very rare governments defaulting. Generally, governments would pay. As a result, we consider government bonds are the less risky instruments. And they are tradable. They are initially sold at auctions and thereafter you can buy and sell these in the markets. And the prices or the interest of these bonds are determined in the market. Market means demand for bonds, supply for bonds. Demand for money, supply for money. Based on the demand supply interactions, the prices or the interest are determined in this government bond market. So we already know there are two types, treasury bills and treasury bonds. Treasury bills are basically short-term instruments which are having a period of 1 year maximum. So as a result, we call them as treasury bills as money market government securities. These are money market instruments. Money market means they are traded only up to 1 year. Treasury bills. But they are considered as most marketable security. Treasury bills are very liquid. They are traded very marketably in the money market. So as a result, we consider the treasury bills as liquid as close to money. We know money, 100% liquidity is there. Treasury bills, they are very close to money because they have high liquidity, trading very frequently. Usually they have three maturities, 3 month, 6 month, and 1 year. Or sometimes you call them as 91 days, 182 days, and 364 days. The most important thing of treasury bills, they are considered as zero coupon securities. In a treasury bill, you don't have a coupon. It's a zero coupon instrument. In other words, you cannot say a treasury bill pays 5% coupon rate. There's no such coupon. So if someone asks, name a zero coupon security or a bond, what you can say, the answer is treasury bill. There's no coupon attached to a treasury bill. Treasury bills are normally sold at discount. What do you mean by that? When you buy a treasury bill, let's say the treasury bill value is 100 face value. So if you buy this treasury bill, you will have 100 worth of a bill with you. But this 100 is actually 100 at the maturity. When it matures, it will be 100. But you buy it at a lower price. Let's say you are buying at 90. So purchase price is 90. What does that mean? The difference between 100 and 90, there's a 10 rupee difference. That is your money income. So upfront, you are getting your income. Why? At the maturity, you get basically 100 value treasury bill, but you are only paying 90 today. So this difference is called as the discount. And through the discount, you earn this interest income. So the difference between purchase price and the face value is the interest income. I think I already mentioned to you, these are the, there are some, calculations to be done based on this idea. We have to calculate the return of a treasury bill. There are some exam questions related to this. We'll come back to that point in a while. Some calculations. But the idea is you earn your income upfront. Okay? I already mentioned to you, treasury bills are the most liquid instruments that we have in the money market, because in the secondary market you can trade it very quickly and easily. Treasury bills. Then let's look at treasury bonds. Sorry, treasury bonds here. Treasury bills are only up to 1 year, but treasury bonds are medium to long term instruments, which means starting from 2 years to 30 years, I think it's given here, 30 years you can issue treasury bonds. In some countries, even you have 50 years, 100-year bonds. I remember Mexico has issued a 100-year bond. It's too long, but they are long-term instruments. As a result, we can call them as capital market instruments. So treasury bonds are capital market instruments. Treasury bills are money market instruments. So I already mentioned to you that I shoot for 2 to 30 years, a long-term basis, and it's an interest-bearing security. Treasury bill is a zero coupon security, remember? No interest. But a treasury bond is a interest-bearing security. What does that mean? You get a coupon out of that. So they are coupon-based securities. This coupon could be annual coupon, biannual coupon, 3-month coupon. Likewise, biannual means every 6 months. Quarterly means every 3 months. You get a cash flow. So which means there is a regular cash flow out of a treasury bond. Every 3 months or 6 months or 1 year, you are getting a cash flow because its cash flow is attached to that treasury bond based on the interest. And these are also tradable, even though they are long-term securities, long-term instruments, they are actually tradable in the market. People buy and sell these treasury bonds. People, let's say someone buys 30-year treasury bond. That does not mean he will keep that treasury bond for 30 years with him. He will trade it. In the secondary market, we know there are a large number of transactions happening. So out of such transactions, somebody might sell it, or somebody might buy a treasury bill. So the tenor does not matter whether it is long term or short term. These are tradable long term instruments. You can also add one thing we have already covered earlier in the treasury bonds. The interest sensitivity is higher. Treasury bonds are highly interest sensitive. Remember, we told that, or we saw that when interest rates are going up, the value of the bond falls. If interest rates are reducing, the value of the bond increases. So which means the treasury bonds are very much interest sensitive. Okay. So these are, even in Sri Lanka, we have these instruments issued in the Sri Lankan market. Now, someone asked me in the chat box, I think it's a good question. Then you will have some idea about some type of bonds. Before we go to this calculation, probably I'll discuss that part. Someone asked me, what are these panda bonds? Probably you may have heard this term, panda bonds. And if you go further, there are other names like samurai bonds. There are bonds called sukuk bonds, international sovereign bonds. What are these? Maybe I'll add a slide here, then we can use that slide as a additional discussion. Okay. What are the points that you have raised? International sovereign bonds, right? Then someone asked me panda bonds. And I'm adding another bond, samurai bonds. Then I'm also adding sukuk bonds. I'm also adding green bonds, right? So likewise, there are a number of large number of instruments. So what do you mean by international sovereign bond? Can someone give me an idea? I think I discussed this last week also. I gave you some idea about international sovereign bond. What are these? International sovereign bond is a bond used by sovereigns, which means governments. In short, you call them as ISBs. ISBs are bonds used by governments to raise foreign money. To raise foreign money. So these bonds are generally denominated in foreign currency. I hope you remember the term I used, a term in the previous discussion, Euro bonds. Euro bonds means sovereign bonds, which means a particular country is issuing a bond in international markets, not from their own currency, but using a foreign currency. For example, Sri Lanka is issuing a dollar bond in USA. It's an international sovereign bonds, right? Clear? Then panda bonds. What do you mean by panda bonds? Where do you find panda? In the zoo or where? Hmm? Where is panda?
China.
China. Yes, it's in the Chinese market. So if it is the Chinese market, what do you mean by a panda bond? Any idea? In the same way, where is samurai? Samurai bond? What do you mean by that? In which country?
Japan.
Japan. Okay. So which means depending on the country, you can see panda bonds, samurai bonds can be issued. So what is the feature of this bond? Panda bond, or I think in one of the exam papers you had this question. I exactly can't remember in which paper. I can't exactly remember, but I remember in one of the papers you had this panda bond. So a panda bond or a samurai bond indicates a panda bond issue is issued in China in their own currency, renminbi, for local investors in China by a foreign company. or a government. Clear? A panda bond is issued in China in Chinese currency for Chinese people by a foreign company or a foreign government. For example, Sri Lanka can issue a panda bond, which means we go to China and issue a bond to Chinese people, but that bond is owned by the Sri Lankan government. Similarly, samurai bond means a Japanese yen denominated bond is issued in Japan for Japanese people by a foreign company or a foreign government. Sri Lanka can go to Japan and issue a yen bond there for the Japanese people in Japanese currency, as I mentioned, yen, for the Japanese people. So these are new types of instruments to raise money from their, countries. Then what is sukuk bond? Sukuk bond means Islamic Sharia principle based bonds issued in Islamic societies mainly. Sukuk bonds are based on Islamic Sharia principles. Sharia principle means, I think maybe you have some idea. The idea is basically not profit making, not interest based. Basically, it's profit sharing. In a sukuk bond, you don't have any interest. They call it any profit. So when you earn out of that sukuk bond, you call it a profit sharing. So based on these Sharia principles, Islamic countries, they issue bonds to international investors. The most common sukuk bond market is Indonesia and Malaysia. They are issuing Islamic principle-based bonds to foreign investors. Then we have green bonds. Green bonds means those are issued for specific purposes. Green bonds are used for green economic activities, which means environmental friendly, environment risk free investments. Countries can issue green bonds, companies can issue green bonds, and these are issued for specific investors who are willing to invest in green bonds with an environmental concern. Normally, money raised out of these green bonds are used for environmental activities, conservation, environmental protection, likewise. This is an emerging market. In many countries, we observe this green bond market is emerging, right? So I think it's a very good question someone raised. I was actually planning to discuss these exam questions, including panda bonds. But someone raised this question, then all these things came into my mind because these would also be important. Right. Now, in the next slide, I have given you a calculation where to calculate the return of a bond. Here, what we do is we basically calculate return of a bond. Right? So bond yield equivalent means actually the return. I told you, if the bond is 100, bond in the sense what we are doing here is bills actually, zero coupon bonds, right? We are not talking about bond valuation, bond prices, because it's a cumbersome activity. It's not simple. In our syllabus, what we really need to have is get the return out of a treasury bill, which means a zero coupon bond. We know zero coupon bond is sold at the 100 face value bond is sold at a discount, which means the bond price is lower than the face value. That is the idea of discount. So based on this discount, we can calculate the return of this zero coupon bond. So in the next two slides, I have taken some exam questions and done some calculations. So I think it's very self-explanatory how to do it. I request you to try these things in your leisure time. And as I said, in one of the exams, we have seen this zero coupon bond. So these questions, as well as I have added few questions at the end based on the previous exam papers. So I really recommend you look at these questions and do some calculation. 2 marks guaranteed. I think this 2 marks in the first question. In every paper you have a similar question. So try it, and as I said, 2 marks cannot be ignored. It could be determining your pass mark. So it's really simple, straightforward. You can claim these marks. So please do some practice. So before you come to the class, as I said, try some questions, and let's try to discuss couple of questions. Then you will have some clear idea about how to calculate these things. And then let's move to the balance part of this discussion, repurchase agreements and all that. Actually, I was planning to finish off the discussion today if I had sufficient time, but as I mentioned, I spent some time on the explanation, so I think it's helpful, and also we discuss something additional. We'll postpone the discussion to the next week. We have time, but when you come back, please do some homework, some calculations. Okay. Now for the plan, upcoming plan, next week we don't have classes, right? Next week we have a break on 17th, New Year holiday, and after that we will be meeting on 24th Saturday, and 24th, and then one more session, one or two sessions by early May. We are done with our discussion, and I think revisions are planned for late May and early June. So hopefully your exam is basically in June, as I understand from the plan going on. Okay, shall we stop here? And may I wish you a happy Hindu and Sinhala New Year, coming New Year. And I understand Monday is also a holiday. Many people can have some relaxed time on Monday as well. So have a great time. Stay safe, even though you celebrate New Year. Stay safe, especially when you go on shopping and all that. And have a good time. Okay, let's meet up after the New Year break on 24. Let's stop here. Thank you.